Okay, good morning, everyone. February 4th, Retirement Plan Subcommittee. We can start with agenda says review of the minutes. I don't remember whether we vote on them or not, and I don't even know if we have enough people, but did anyone have any changes? Anyone have any changes to the minutes? I
I
did
went
not.
over them. They looked accurate.
Yeah. Okay. Let's vote on them just for cleanliness, I guess.
I'll make a motion to approve the minutes of, sorry, I don't have them right in front of me.
December 3rd.
Thank you. Does that mean you want to second that?
I do. I second that motion.
Okay. And then all in favor, we'll say aye.
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 Okay. Um, Those are approved. Uh, Thank you. And we'll just move right to, I think Chris will start out.
Yeah, it feels like I've seen all you folks a cluster the last couple of weeks, which is
No.
great. But good to see everyone again. Good morning. I'll bring up the slide deck momentarily. I think Tyler and I reviews are pretty straightforward. Just as a brief intro, you'll remember this is the quarter where we reframe our expectations around capital markets. We'll do that work at the end of the calendar year previous, and then we test the portfolios and kind of our return expectations with your standing allocation. So we'll talk you through some of that detail. It doesn't look like, from our standpoint, it rises up to the level of any type of action needed on the existing allocations, but it's a good verification process and check-in nonetheless. So bear with me here. I don't know why let me just do this. I don't know why my system does this. I had it all teed up. Here we go. Yeah. Share. Here we go. Folks, see that okay?
Good on my end.
Yeah.
Great. Thanks. Thank you for your patience there. I should be acclimated to Zoom by now. No, anyways, so we'll kind of run you through all that. Maybe, but a good precursor to that, though, we'll kind of catch up on markets just generally and kind of where we stand today. And you'll see here, as the new year takes hold, just a couple of themes and things to be familiar with in terms of the backdrop in the markets. And probably front and center is this idea that you've read, right, and we've talked about there being pretty good equity market returns the last couple of years, particularly so in the US, and then even more particularly so with large cap US equity, as you know. And that's created a level of concentration, and I don't know, vulnerability, but an awareness that we just need to be mindful of in terms of the portfolio and its construction. And we'll piece that all together and make sense of it momentarily. Just in terms of, if you look at assumptions year over year, there's not a lot of obvious places or so-called fat pitches. I think markets generally are expensive, both equities and fixed income. I think that kind of leads you right to the conclusion that just kind of, again, validating the diversification of your program and its resiliency is an important kind of consideration, and we'll talk through that. And then finally, we've always advocated, as you know, for a thoughtful mix of active and index strategies in the pension programs, and it may be coming there may be, just given the circumstances in markets and that concentration I mentioned, a little bit of a lean into, active management, if you will, maybe having a somewhat better potential to, on a sustained basis, outperform. You all know for a long, long time, the indices have been, particularly the large cap indices, have been pretty dominant in those regards. So those are big picture things. This is an interesting page, and I know there's a lot on it, and we won't get too much in the gory detail, but we thought it was an interesting exercise. We've taken the largest names in the domestic large cap index. You see them in the left-hand banner there if you run your finger down the column, and just thought it interesting, right? They have an outward and a very large effect on the prospects and the outcomes for the entire market. So at the very top of the exhibit there, you'll see what we did is we just said, oh, what if we just had a representative return in the broad markets, call it 7%. And what would be the effect if those large cap names that are so expensive didn't actually continue to run at the levels that we've seen the last couple of years? And you see there, for example, if those top 10 names in the index S&P are flat, it almost cuts the return meaningfully by 2.5% there. You see 7 to 4.5, and then if you work your way across just to kind of play into that theme. If you even more concentrated returns, right? If you get a bit of a sell-off even among the very biggest names, it can have a meaningful effect and really wash out and extinguish the returns of what could be a stronger market elsewhere. So just something to be mindful of. As you know, as we'll see in a minute and revalidate, your portfolio has lots of allocations to other things by design, but it is telling, right, just how concentrated those returns have been. And it's really, really tough to have that really strong top line growth that you've seen with some of those big tech names, for example. And on the right-hand side of the same page there, you can see just year over year how difficult it is to achieve those outsized sales growth type of numbers. It doesn't happen that often. It's really difficult to do. And if you believe in a measure of mean reversion, and I think we do, right, over time, you just got to be mindful, right, that these names, the Nvidias and the Amazons and the Metas are not going to likely run wild forever. So that just gives you a little bit of sense of that first theme. The other thing that we've spent so much time talking about over the last year or so is inflation, as you all know. We know the Fed's cut rates, right, pretty dramatically, and that has called inflation to a good measure. Down in the, see there, upper left-hand corner on the left-hand side of the exhibit, 2.7% is the run rate today for headline inflation, a little bit north of their so-called target of 2%. And we have an expectation it's going to be really difficult for them to, given the circumstances, get down to 2%. If you think about things like immigration policy and some of the trade policy and tariffs and the deficit situation, those, historically have been inflationary influences, right? And it makes it difficult for that inflation number to come down more. We suspect that's why, as you've read, right, the Fed is kind of on hold right now with further rate cuts, right? They certainly don't want to get into a situation where they offer too much relief and inflation starts to spike again. So we expect that inflation number will continue to run, much, much lower than it's been, which is great, but maybe not quite at the Fed levels, where they ultimately test to. And they may be accepting, right, of a slightly higher number given the circumstances. The bond market's, saying something very different too. So on the right-hand side of that same page, you'll see that the dark emboldened line there, the black line, is what's happened to interest rates most recently, the 10-year Treasury yield, since the Fed began cutting. And you can see there, pretty interesting effect, right? The 10-year yield's going up. Not typically what happens when the Fed starts offering relief, as you can see there by the other time frames that are highlighted. And that is certainly, right, some indigestion that the bond markets are kind of navigating their way through right now. And certainly concern, I think, we think just about what that happened with trade policy and inflation and all the other things, deficits and whatnot. So there's a good deal of uncertainty in markets right now. Again, not a call to take any dramatic action, but more of an awareness that we do think volatility will be heightened here for the foreseeable future. And then finally, before we transition over to the portfolios, just so you've got the frame of reference here, I know we've met fairly recently, so some of these general numbers are familiar, but you see here with the benefit of the full fourth quarter was kind of a mixed one. So bond markets, you see in kind of the left-hand side of the exhibit on the top half of the page, were down a bit. Broad investment grade fixed income securities down about 3% in Q4, and gave back a lot of the return they had accumulated through, for example, the fall. So now we're up a little bit north than 1% for calendar year 2024. And then equity markets in the middle of the page there, kind of the relationship that we've talked about the last couple of quarters, right? That predominant return profile for large cap U.S. equities over everything else, but positive returns elsewhere around the globe. although a measure of softness in Q4 in the international markets, you can appreciate, right? Again, all that tariff chatter and trade policy chatter has weighed on those markets just a little bit. And then kind of a mixed bag as well for some of the diversifying asset classes, things like real estate and real assets. A little bit of a consolidating quarter, but they did kind of make their way to modest positive returns for the full year. Anything, let me do this. Let me stop sharing for a minute. Anything from the committee on big picture stuff? Yes, Lisa.
First of all, thank you. A lot has changed since we last met, actually. One of the questions I had at the time we met, you gave us an estimate for investments returns about 3.75 or 4%. Has any of that changed given what
for Fed funds, Lisa, right? Yeah, and what you might get on money rates. No, I don't think so, right? Because the Fed, while there's been a lot of noise and conversation, right, the Fed still likely is in a holding pattern. Money market rates today are around 4-ish still, right? I think we talked about in your exercise a measure of conservatism because in all likelihood, and all else equal, even with some of this noise, right, we suspect ultimately the next Fed move is likely another cut or two. So I think we talked about, right, a 375 settling in on that number, as you mentioned. I think that's still a good proxy for money market yields for the time being.
Do you have a range that you anticipate, or is that like your recommendation?
Well, I mean, that's, we don't point estimate, or, for forecast with precision those rates. I would say if there's a range, right, the forward markets are still expecting 2 cuts between now and the very end of next year. So does that put you at a 350 to 4 range, right, to encapsulate that? Maybe.
Perfect. Okay.
375, kind of the midpoint, right? Probably puts you in good stead just to get started with that type of exercise.
Perfect. Thank you.
Make sense?
Yep.
Anything else from other members? Folks, okay? All right, let me pull the deck back up and we'll quickly get you through some of the rest of this. All right, so I'm going to segue over here. Bear with me. I'm going to move John. There's a lot more detail there, as you know, but in the interest of time and whatnot. So this is the quarter, as I mentioned, right? Fourth quarter, asset allocation review. What are we doing with capital markets? What are our expectations around markets? We've got a team that kind of works through all that analysis. This is a framework of the process, which in the interest of time, I'll skip over. There's a couple of big picture things that just come out of the year-over-year analysis here. And again, I'll kind of start at the top of the page, and then we'll show you some of the data. And then more importantly, right, we'll show you the actual portfolios and what we're expecting there. We talked a little bit, we do have more modest expectations really for all asset classes. So we talked about those elevated valuations for equities. Fixed income rates have moved a little bit higher very recently, but year over year had been pressing lower. And the spreads or the incremental returns in non-treasury markets were still tight. So we had somewhat diminished expectations there and really across the entirety of asset classes, as we'll show you in a minute. Somewhat more modest return expectations going forward. We've talked about just the complexion of uncertainty around interest rates and fixed income securities generally. You'll remember we've got a strategy explicitly in your program in the form of BlackRock, which provides a kind of what we call a dynamic bond allocation. It's a little bit more flexible, and we continue to lean into that, and will not make any recommended changes there. So you're kind of profiled accurately from our standpoint with that backdrop. We talked a lot about kind of the narrow nature, right, of equity returns, particularly the U.S. returns, and kind of staying, true to those global equity allocations. You see there, we highlight in the middle of the page just what the complexion of global markets looks like. And there's probably, we think, right, all else equal, again, mean reversion being a guidepost here, we think there's good opportunities in small and mid-cap U.S. equity in some of the international markets, and you have representative kind of lean-ins, if you will, or tilts into those areas, again, consciously and by design, to get you away a little bit from the, the vulnerability of those large cap valuations. So I think we're in good stead there. And then we've had real estate and REITs, as you know, those types of allocation, real assets, excuse me, and REITs and those types of allocations in the program as diversifiers. And we think, in good shape there. So the portfolio at its highest level kind of has the orientations that we think make best sense given where markets may be headed. This I'll show you just here so you see it. These are year-over-year expectations for markets. You'll see in the far right column, as I mentioned, right, a bit lower, and that's for fixed income and equities and some of the diversifying asset classes. So a measure lower than where we were year over year. Higher valuations, right, always present a bit of a more challenging hurdle. And we have to be accepting of that, right? And it's kind of reflected in our analytics that you just need to have more modest, somewhat more reserved expectations given those circumstances. So still decent returns to be had, just not quite as strong as they were this time last year. So we'll kind of take you through that. And here's where we started, and more explicitly. Upper left-hand corner of the exhibit is the current mix for the pension plans. You'll remember it's about not quite 2/3, 1/3 now. It's a little bit more than that. We're about 38% fixed income, as you can see, with the balance in equities and real assets. And if you make your way on that row over into the middle of the exhibit in the forecast columns, you'll see about a 7.2% expected return on a go-forward basis for the mix of assets that you have in place for the three pension plans, right? So that, I think, directionally is where we want to be, right? We've got a 6.5% bogey, all else equal, and we want to have a measure of cushion in that, because you'll remember the way we model is to a median outcome, right? So there's a good deal of potential variability around that outcome, and we want to have a bit of protection directionally against it. So the mix of assets that you've got today is diversified. It's statistically efficient. And again, I won't get you into all that noise, but on the bottom half of the page there, if you talk to a financial economist, and does the portfolio, everyone talks about plotting on the efficient frontier. And that's, you see that frontier there visually, and you see that the portfolio, does indeed, it's kind of hidden behind, mix ABC, but it's perfectly efficient, perfectly appropriate, perfectly diversified. And again, from that standpoint, we don't have any recommendations to the committee or see a necessity to make any changes to the standing allocation targets. But again, an important exercise to go through each year just to get you caught up on our latest thinking. So again, I'm going to stop sharing for a minute. I know that's a lot, but see if there's any feedback or input from the committee or thoughts, questions. Nope. Well, good. So thanks for that. Again, a good exercise. We'll obviously bookmark that and memorialize it in all our work product, but we think you're in good working order on the allocation front. And then I will quickly, if no one objects here, forge ahead. We'll use the town plan as we, let me see if I'm in the right spot here. Yeah, we'll use the town plan just as a proxy, right? Because everything is pretty darn close. So upper left-hand corner, right, we talked about markets being a bit challenged in Q4. So a little bit of a down quarter. You see they're down about 1.8 versus 2.1 for the benchmark. A better absolute year for sure. You see the 1-year number, calendar year 24, up a little north of 9%. The longer numbers kind of hovering along those broad market outcomes as well. And, returns kind of generally, aligned with expectation given what's going on in markets and the way the portfolio is allocated. And for the town plan, about a $2.5 million investment gain, ending at just about $30.5 million of invested assets at the end of the calendar year. Just the complexion of returns, so you see it more explicitly, the mix of managers, right, pretty close to target. We've had a little bit of liquidity here working with Amy and team, but otherwise allocations are in good working order. And from a stance standpoint, just for the record, no concern at the individual manager level. So if you go up and down the left-hand column there, all the managers and strategies on maintain. And from our research team standpoint, in good working order.
Question?
Yes, ma'am.
Could you talk about the issue with liquidity?
Yeah, I think I've got to go back and check. I think, I'm trying to remember, Lisa, I think we typically raise towards the end of the quarter, right, for forthcoming need. So I think here, I've got to go back, I meant to, and look at the record, but I think with Amy, we worked just toward the end of the year to raise a little liquidity for the new calendar year, Jan, February, and March typically. So I think that's why it's a little bit elevated there. I didn't look at it last night, but I think we spent a bunch of it down already just for pension payments, right? I think so. I think it's a point in time thing, and it just would coincide with a raise right in front of the new, the inception of the new quarter, Q1 25.
Okay, thank you.
And, fortunately, again, we've talked about, right, the opportunity cost to have a little bit of extra liquidity right now still is somewhat diminished, right? As we mentioned, you're getting, 4% on that all spring fund and actually clipping a nice yield, even as those monies kind of await their, their ultimate destination. Board of Ed, right, similarly, right, as you would expect, I won't go all through all the numbers again, but same allocation and, same circumstances. $2.5 million gain as well, and just about $30.5 million for Board of Ed. Allocations, again, same thing here. So I think, Lisa, this is kind of bringing my memory back, right? I think we raised at the very front of the quarter, at the very end, rather, just in front of it. So that's why you see that there. And then police as well, right? Similarly, again, right? Everything kind of comes together as you expect, and looks like about a $1.8 million gain and about $22.6 million of invested assets at the end of the year. Same profile with a little bit of lean into liquidity there. And then just switching gears, and then I'll pause and take questions. So we ran an exercise for OPEB as well, right? So remember, this is for the time being an all indexed allocation, and one that's been pretty effective. The allocations are very, very similar, not identical, but you see they're very similar in the upper left-hand corner to what we've got expressed in the pension plans. This pool, right, is a little less mature than the pension plan, so a little bit more lean into return-seeking assets, but very similarly, right? Kind of a low 7 type annualized return number and efficient mix of assets at the strategy or the asset class level, and no concerns with the standing allocation. And this portfolio, right, kind of mimics markets, right, as we've talked about in the past many times, because of the nature of the investment strategy currently. And upper right-hand corner of the page, right, it looks like about a $2.1 million gain for the quarter, $24.8 million OPEB trust pool, which again, commendable to the board and the town. It's a very healthy balance for
Question?
a liability, right, that's kind of new to a lot of municipalities, right, and something people are still getting their arms around. And then nothing on the really on the allocation front. We're pretty close to tolerances here. We're a touch overweight domestic equity, but I don't think it rises to a level of action. Some of that noise has been canceled out, honestly.
Lisa, did you have a question?
Yes.
Oh, go ahead, Lisa. I'm sorry.
But one of the things we noticed at our last quarterly report is there have been nothing taken out of the OPEB funds. Can you talk to us about how we're funding OPEB, how we're paying people?
Yeah, I thought, Lisa, what Amy had mentioned right on the meeting was that you were still funding on out of the confines of the trust itself, right? Was it still kind of a pay-as-you-go mentality for existing obligation, and we're still funding up the trust to a certain level?
So I was not, it wasn't clear to me, but I just wanted to confirm nothing's coming out of the trust.
Yeah, no, we don't see meaningful outflows from the trust.
Okay, so maybe Todd, for our board, that's something to follow up on, just to sort of see what the plan is and why that is, and should we continue it? I mean, we're well funded at this point. Yeah, I know Amy had talked about tapping the fund going forward. So
yeah, it's not Lisa unusual. A lot of your companion towns, I think, similarly kind of form the trust, making commitments to it, kind of funding it up, and then kind of finding what they needed for current liabilities outside of that to not kind of implicate the momentum of that, contribution strategy. So it's not unusual directionally from what we've seen, but Amy's probably better, equipped to get you the detail.
Yeah, no, I'm just thinking in terms of the budget. Obviously, if we're funding it out of current expenses and we have a trust that we can use and we're
Yeah.
dealing with a very tight budget, when does it
And
make
it's-
sense to do that transition?
Yep, absolutely. Yeah, no, absolutely fair point, right? And certainly that, as you all know, is very liquid and you can turn it into cash, next day. That's so by design.
Okay. Thank you.
So I think we're in good working order on OPEB, and I think that's all I had on my side. But happy to take any last questions before Tyler gives you his update. Looks okay? All right. Tyler, you're going to share on your own, or do you want me to pull it up? I don't think we're okay.
There we go. Works for everyone? Everyone can see it? Perfect. I get to, so this quarter, obviously, fourth quarter, we get to talk a little bit about any of the changes from a regulatory legislative standpoint. I'll, take the enjoyable topic of discussing a little bit of politics and its impact on DC and retirement plans. So, and then of course, I did include the investment policy statement that we used to be the roadmap on how to select, monitor, replace investment options. And we've I believe, we always review it, but last adjusted that IPS in 2022, and I don't have any changes to that document. So, very busy slide. I'll give you the gist of this. So these are kind of all of the pending regulatory and legislative topics that are going around in Capitol Hill. One being the ability. So, collective investment trusts have been around for a long time. They're always and have been in the 401k space forever. 403b plans have not had access to collective trusts. That in the long and short of collective trusts is it's the ability to get access to the same mutual funds through a pool that provides lower fees. And for whatever reason, 403bs haven't had access to them. The Secure Act, which I'm sure everyone remembers me talking about it over the last few years, had a provision that would allow 403b plans to get access to them. The problem is it's really governed by the SEC, and so we're waiting on more guidance on when the Congress is going to allow for 403bs to add trusts. And as soon as that does happen, we'll bring the potential for lower fees to this committee. But right now we're kind of in a holding pattern, specifically 403b plans. The other two provisions, one is helping Young Americans Saves for Retirement Act, which is really right now you're able to exclude anybody under 21, and there's discussion around moving that to 18, and it goes with the theme that the federal government has been looking to get more and more access to retirement plans to more and more people, and so we may see a pivot or an adjust to eligibility getting drawn down to 18. You have the ability to go there now, but the minimum may change over time. And then I probably talked about the fiduciary role in different iterations for the last 15 years. There's been a new, I'd say, proposal around the fiduciary rule. And again, what I mean by fiduciary rule is the umbrella on who is the fiduciary with respect to what type of advice people provide to plan participants has changed over the years. And I think this newer rule that's being proposed is including advisors who provide advice around rollovers, IRAs, annuities, sort of one-time advice to plan participants around moving their investments to these various vehicles. And I do think this is probably going to go through, and what it would mean is that there's more disclosures provided to plan participants if someone is providing, advice around IRA rollovers, which may impact a lot of record keepers out there, the Fidelities and the TIAs and the Voyas, where if someone leaves the town of Simsbury, they usually have a team that will reach out to those individuals and say, hey, have you considered our IRAs? I think there's going to be more regulations around what type of disclosures they need to provide around that type of advice. Now, outside of all this, from a regulatory standpoint, I do get asked, with the new administration, what else are we looking at, and what else is that, and how else will that impact the defined contribution space? The one, and this is not on this slide, but the one that we, obviously keep expecting is the current administration probably going to reinstate a ban on ESG investments, or this committee having a conversation around ESG. You don't have any those types of investment options now, but if you were to say, the town board would really like to add a low carbon investment option, or whatever ESG you can think of, we expect that the Trump administration will probably reinstate a ban of us having that conversation, as opposed to a discussion around the pure investment merits of that particular fund. So that's what we probably expect. The other two things that we'll probably may see trickle or sneak its way into retirement plans. We keep hearing about increased access to potential private equity investments. Cryptocurrency may squeak into the defined contribution space. Again, not something we're in any place recommending, of course, right now. But given what we're hearing about the new administration, we may start to see and hear more of that trickle into the defined contribution space than before. So, just a few kind of high level things around Capitol Hill. And then from a litigation standpoint, there's been a couple court cases that may or may not have an impact on the defined contribution space. One is the Loper Bright Enterprises court case that reversed sort of a 40-year Chevron versus National Resource Defense Council, which actually is a client of ours. And this particular court case was not a 401k court case, but may have broad and sweeping impact on the defined contribution landscape. What this court case really did was it reversed the Chevron doctrine, which was a legal principle that says courts should defer to federal agencies when Congress hasn't made laws clear. So for this particular court case, it was the EPA and the FDA and the FCC impact, but what this may have is much more sweeping impact to other agencies, like again, the defined contributions ruled by the DOL, the SEC, and if courts find that laws are broad, they may just interpret and make decisions on those, as opposed to passing it back to guidance from the DOL or the SEC. So what you may see, again, this will have impact on ESG and ESG investment options. It'll make the guidance around defined contributions very murky, because you may have one court say, we interpreted the DOL this way, and you may have one court case say, we interpreted it this way, as opposed to passing it back to these federal agencies to get more guidance. So the long and the short of it is it makes it gray, a lot of things gray. What I do actually really believe it's going to make the federal agencies like the DOL and like the SEC a little bit more hesitant to issue new rules on 401k plans, because they believe obviously courts will scrutinize them. So more to come on this, but I think it does have broader impact to the defined contribution space. Overall, though, and again, this is the market. We're seeing an uptick in the industry, seeing an uptick in litigation. One that doesn't have impact on your plan may have impact on the 401k space in general is the use of forfeitures. Again, you don't have unvested forfeiture dollars And forever, the DOL has sort of said, and forfeiture just means if you have a vesting schedule in a retirement plan, if you didn't have the tenure to earn the dollars you got from your employer, you forfeit those dollars after you leave. And employers can use those dollars for a lot of different reasons. And the DOL has, provided guidance on that. And one would be you could take that dollar that's forfeited and you can use it to pay your matching contributions. So that's reduce your employer contributions here as one of those options. The others, you could use it for expenses. You could say, our audit fee or advisory fee, we're going to take those dollars and use it for expenses. The last option is just giving it back to everyone, just taking that pool and saying, we're just going to, pro rata, give it back to everyone as a sort of bonus at the end of the year. The odd thing about this case is, or in a few cases that have gone out 25 actually, to be exact, is that if your role as a fiduciary is to act in the best interest of plan participants, the only decision you can make should be giving it back to everyone, as opposed to use it to offset expenses. So it even though the DOL has outlined what you can do, courts may reinterpret per the previous court case what you should be doing it with it. Because obviously there's this argument that if the best interest of plan participants is just giving it back to them, then why aren't you doing that? And so it doesn't impact your plan. It's more impactful to the entire industry. And we're talking billions and billions of dollars that get reallocated in different ways. And so we'll keep an eye on this. And again, more to come on it. Nothing that you have to act on now. And there's a specific court case that's continuing on. And we're obviously, watching this, this Clorox case specifically around what courts will say plan sponsors should be doing with respect to retirement plans. But again, I think it has sweeping impact to the defined contribution space in general. I'll pause there before I move on, in case there's any questions. We include this slide every year. It's just sort of what defined contribution plans should be doing. Do you have an investment policy statement? Do you meet periodically? Of course, you have periodic meetings with a quorum. Bonding and liability insurance should be considered. We spent some time a couple quarters ago talking about participant education, advice, plan design. I will note that there's one of these bullet points is having a planned procedure for locating lost participants. There's a lot of disclosures that are required that are part of the defined contribution space. Fee disclosures, statements, other things. When people leave and then move and then move and then move again, you should have a procedure for locating those individuals. And Mission Square does have a procedure that's laid out. They will, have a best effort attempt to find the most recent address for those disclosures. And so you're good on that. And then next quarter on the bottom there, we'll be spending some time on fees and making sure the fees are reasonable. I run the record keeper oversight committee, and so we evaluate Mission Square along with the other record keepers that are out there. And so no concerns there. Of course, last quarter we did do an overview of cybersecurity protocols as well. So I think, as we check off these items, you should feel like you're good stewards of the retirement and the defined contribution space. I did, as mentioned, include the investment policy statement. So it's outlined here. Again, this is our roadmap for this committee. How do we evaluate investment options? If we ever feel that we need to replace those investment options, what's the criteria for replacing, and then how do we behave when we do, as we did a few quarters ago around one of our fixed income managers, similar to the pension side. And so this clearly outlines that, but it also never paints you into a corner. Again, this is a governing document, but you'll note throughout this document is that it'll say things like the committee will meet periodically, that these may be the reasons why we may terminate or replace an investment option. It never be a hard and fast rule, as in just saying this committee will meet quarterly. If for some reason say a global pandemic happens and we miss a quarter, you're not in breach of this document by not meeting. Or if sometimes we'll see parts of this document that will say, we will absolutely replace a fund if it doesn't outperform the index over 5 years. Well, an index fund will never outperform an index over those 5-year periods. So we do think we're following this document fairly well, and don't recommend any changes to the current investment policy statement. Of course, Chris went over the capital markets. Usually we pull this out, but when we look at the balances up from 17 million around end of March to close to 19 million end of December. So good movement from an equity standpoint. I think you could see bulk of the assets in the S&P 500. The next highest pool is the default target date funds at close to 20%. So between the S&P and the target date funds and then the stable value, you're talking about 70% of the overall assets. With the Board of Ed plan, that 403(b) plan, you could see more assets in the target date funds and the stable value. But similar story there, up from 1.7 to close to 2 million end of December, and then the 401(a) up from 1.5 to close to 1.8. More, given that 401(a) is a newer plan, obviously more assets in the default fund, which are the T. Rowe Price target date funds. I include this slide every quarter. It's the sort of overview of how the target date funds work, and because they're a little bit different than other mutual funds, they're dynamic, they evolve. There's a strategy around that. We spend a whole quarter talking more in depth on the target date funds, and so no big concerns with the target date funds here. No big changes. Little higher equity position, as I've talked about in the past, and that's been quite beneficial from a performance standpoint. As you can see, the target date funds are all on maintain and performed quite well over the last 5 and 10 year period. Little noise on the quarter from a peer standpoint, but overall good performance over the last 10 years. And then we do have MFS Value Fund on discuss. There, Naveen Chikara announced his retirement or pending retirement May of 2026. And so that is of note. Still outperforming longer term on from an index standpoint, but of course lagging some of their peers given the more conservative protects on the downside, and obviously less concentrated on some of those names that Chris reviewed during the capital markets. And so that's weighed a little bit on the near term performance, but I think positioned well if we were to see a reversal in some of those Mag 7 names. The rest of the portfolio in line with expectation. The Hartford International Opportunity Fund, performing well, but on watch given a retirement announcement, but no significant concerns from a performance standpoint. So I'll pause there and open it up for questions. Any questions on the funds or Capitol Hill or any of our expectations around what could change over the next 4 years? As if I could purely predict any of those things, but excellent. Well, that's all I had. The other things that are not on this deck around the Secure Act that we can have conversations internally around is some of the optional provisions that have been allowed for retirement plans to offer, like more access to money for people who are, unfortunately in federally declared disaster areas and victims of domestic abuse. We can have those conversations around access to monies and other things that the Secure Act now allows for. But again, those are all optional provisions that we can address down the road. So.
Thanks, Tyler.
Yeah.
Thanks, Chris. Is there anything else that anyone else would like to ask or bring up? Otherwise, I know our next meeting is scheduled for May 6th, Tuesday, also 8 a.m. Thank you all for joining, everybody for watching, and I'm gonna move to adjourn.
I move to adjourn.
Okay. I'll second it, and all in favor?
Aye.
Aye.
Have a great day, everybody. Thanks again.
Thank you.
Bye, everyone.
Yeah.
Thank you.